19 of 19 series are aligned with STAGFLATION mild this morning. That is complete regime agreement across the engine's 19 series. The current macro regime is STAGFLATION mild with a confirmation score of 19 out of 19. In regime terms, the engine is observing a STAGFLATION mild macro regime, defined mathematically by growth momentum decelerating at -0.5919 and inflation momentum accelerating at +0.0081. 1. The coherence score remains consistent with this configuration, and the confirmation score at 19 out of 19 represents maximum alignment across the 19 series the framework tracks. 1. Historically, regimes with a confirmation score in this range have persisted in about 52% of comparable cases over roughly 3-month windows, with the most common transition being into an acceleration-type regime once one side of the growth-inflation pair breaks out of its prior band. Compared to last week, regime alignment has firmed, with more series now synchronizing around the same stagflationary profile rather than oscillating between adjacent states. In past data, environments with this combination of decelerating growth and mildly accelerating inflation have coincided with compressed equity valuation multiples, elevated dispersion across sectors, and more frequent volatility spikes, particularly when policy and inflation uncertainty were high. Those are descriptive observations of how markets have behaved under similar math, not forward guidance. On the yield side, the 10-year Treasury is trading just below the 4.45% trigger level defined in our regime map, with the curve configuration contributing to a red momentum label, meaning yields have been rising relative to their 3-month baseline. In 8 of 14 comparable periods, this coincided with equity volatility indices spending more time above their 60th historical percentile within the subsequent quarter. That pattern is a historical coincidence in the sample, not a prescription. Labor conditions, represented by payrolls and claims composites, currently register red momentum under the engine's definitions, reflecting a negative rate of change versus a 6-month baseline, even as headline unemployment remains moderate in the broader data, 2.5. In 6 of 10 comparable periods, this coincided with softer forward readings in activity indicators such as industrial production and retail sales within the next 3 months. The framework records those linkages as historical tendencies, not as instructions. In credit, spreads and issuance metrics map to a yellow momentum label, defined as a neutral to mildly widening pattern versus their prior 3-month average, with refinancing and balance sheet management playing a large role in recent debt supply, 1.2. In 7 of 13 comparable periods with similar yellow credit momentum under a stagflationary macro label, the data showed an uptick in dispersion between higher quality and lower quality credit performance within a 6-month window. That is a description of past behavior in the sample. Across equity sectors, recent rotation out of some growth and AI-linked names and into more defensive or cash flow-oriented groups has produced a mixed sector map, with certain technology-heavy baskets showing red momentum and some defensive exposures closer to yellow. In 9 of 15 historical periods where sector leadership turned over under a stagflation-style macro regime, the engine observed wider relative performance gaps across sectors within 3 months. Again, these are sample statistics, not guidance. The conditional map currently highlights 2 main thresholds. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, similar configurations in 9 of 11 comparable instances coincided with an accelerating inflation composite in the historical data. Under a stagflation mild regime, that type of move has historically preceded transitions toward acceleration-style classifications more often than not, purely as a mathematical observation. If the Fear and Greed Index drops below 15 and holds there for 5 consecutive sessions, the confirmation structure in 7 of 9 historical instances deteriorated, with fewer of the 19 series agreeing on the same regime. In the past, that type of breakdown has coincided with regimes becoming less persistent and transitions becoming more frequent in the data. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated rules-based engine inside Given Analytics. Atlas is an automated, rules-based engine that does 2 things in parallel. It publishes a view of the broader macro environment, and it runs a fixed 4-layer mathematical framework across 407 liquid symbols every trading day. The environment view and the symbol-level condition log are separate outputs, shown side by side. The regime does not select the symbols, the 4 layers do. Atlas monitors symbols independently of any regime label. Members study the outputs and decide what, if anything, to do with them. First, Atlas publishes a view of the macro environment, the macro regime, the confirmation score across 19 series, and the historical base rates attached to those configurations. Second, Atlas runs its 4 layers: price structure, rate of change, risk regime, and market participation, across 407 symbols each trading day, logging potential conditions when those layers align. These are time-stamped, rules-based readings designed to be studied as historical behavior, not as trade selection. Atlas runs the framework. Members study the environment and the outputs in parallel. Any action, if taken, remains their independent decision. All Atlas outputs are framed as potential, and educational characteristics of the data, not as signals or advice. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.